Hey everyone, in this video we're going to talk about what Apra has just said, like what are they thinking about, why Apra, the Australian Prudential Regulatory Authority, is now cracking down a little bit through the back door on Australian house prices. I just did a video on why they wouldn't crack down in a big way. They seem to have found a backdoor entrance just to kind of soften the property market a little bit. So I'll be sharing my screen, as you can see right here, and we'll be talking through some key points that you need to know, the impact on the property market, whether that will impact bigger cities, smaller or larger than smaller cities. And at the end, I'll tell you a sort of secret way or a not common way, an uncommon way that you can get around these Apra hurdles. Okay, so stick around to the end. My name is PK and I help people build passive income through buying high performance properties using data without needing a 15K buyer's agent. I love this community. Everyone is so awesome. Thank you for always subscribing, for commenting, for sharing the love. If you're brand new, thank you for being here. Hit the subscribe button, turn the notification bell on, hit the like button, give it a thumbs up, and then these videos can go to more and more people. Let's get into it, guys. So have you heard about this, what Apra's just said? Let's go through this article. So from Australian Financial Review, and what they've said is curbs on high debt loans could be a double-edged sword for buyers and investors. Okay, so I talked about in the previous video how investors are only really just coming into the market now, but this is going to impact both investors and home buyers or owner-occupiers. So there's some fluff at the start, which they're saying that, house prices are out of control. Even apartments, that tend to underperform or have underperformed over the last 5 years. Even them, of all asset classes, even those are rising in value. So, they're kind of setting the premise that the market's out of control. Which, by the way, it isn't, but it can seem that way in some markets, especially like Sydney. And then they're saying the regulators have been given the go-ahead to try cool Australia's white-hot housing prices after our Treasurer has basically said, go ahead, Apra, let's crack down on specifically high-debt home loans, right? Because what's happened is that the RBA has been handcuffed. They can't really increase interest rates because the economy is not that strong yet. We still know we're in and out of lockdowns and immigration, population growth stunted, businesses in and out of being solvent. That's carrying on, so they don't have the guts to actually increase the official cash rate, which is understandable, right? And so what that is leading to is asset inflation without the wage growth that normally comes with asset inflation. Wages aren't really growing. And what that is meaning is that debt is coming out of control, going out of control, while wages, although growing a little bit, aren't growing as much to keep up with that debt increase. So the RBA can't do anything. The government doesn't really want to do anything because they don't want to tamper with the housing market, which is really the bedrock of the Australian economy before the election. If they accidentally, sweep the rug from everyone's feet, then they're not going to get re-elected. So they're not really wanting to do too much. So what they have said is, Apra, you be the scapegoat, do something about these house prices, try to do something discreetly. Okay, so that's what that's saying. And then they're saying that this financial review article, this could mean that debt to income ratio limits that would tie the amount of money borrowers earn to how much they could get from lenders. Okay, so effectively debt to income ratio limits. What this means is that when you apply for a loan, there's a certain debt to income ratio that a lender will see you as either fit or not fit to get a loan. For example, if you make 100K and you want to try get a debt of 500K, to buy a house of however much, then that's 5-to-1. Debt to income, 500,000, 100,000, 5-to-1. So what they're saying is that they want to limit how big that ratio can blow out to. They want to clamp down on it. And here they're saying investors would be hit hardest, but some first home buyers would be caught out too. And any crackdown would cause prices to spike even before things get better. So they're looking to do this about 2 months from now. It hasn't really been finalized. The reason investors could be hit the hardest is because savvy investors, they don't buy properties outright with cash. They leverage, because as long as it's positive cash flow, the property goes up in value, it gives you passive income, and you're using only a little bit of your money, 10%, 12%, 15%, 20% of your own money. So investors tend to be the highest leverage. So that's why they're going to be hit. But, listen to the end, guys. It's not all bad. Home buyers would be caught out too. And here's the thing. If you're buying your first home in Brisbane or Adelaide or Perth or regional, it's not really costing you all that much money. But in Sydney, especially in Melbourne, some of these home buyers have got the biggest debt to income ratios. To buy a decent house in Sydney costs at least $1.5 million, depending on who you are, right? And incomes, I can tell you, aren't $300,000 for the average person, right? So debt to income ratios in Sydney are the worst. So in my opinion, Sydney will be hit the hardest. It doesn't mean that prices will come crashing down, but that rate of growth will start plateauing. And, if you're buying these, kind of overpriced apartments or townhouses or houses, really northwest past Rouse Hill, Box Hill, if you're buying, past Leppington on the southwest, Oran Park, and you've had some great growth, or you've seen other people get great growth, and now you're jumping in, guys, it's way too late, right? This is really going to affect the Sydney market the most. Guys, if you're getting value, hit the subscribe button. We're only halfway through here. Interest rates kept low to stimulate spending during the coronavirus economic crisis is fueling the risk of a property asset bubble, and that borrowers will be in over their heads when rates rise. So first of all, rates, when banks give you a loan, they already assess you at 2% higher than what you're actually paying, 2% high interest rate. So I don't fully agree with what they're saying that, borrowers will be over their heads when rates rise. We've still got a 2% plus buffer. People aren't dumb. They know how to do their finances for the most case. And risk of a property asset bubble. This bubble, like I shared with you in the last video, I'll put a link up right here, is not a bubble. It's a boom. And the reason is it's driven by owner-occupiers, not driven by investors who are callous or can be speculative. Driven by owner-occupiers, very sticky, right? Even if this whole world comes crashing down, the last thing people want to do is sell their own home. So I kind of disagree with that, but it's clickbait. It's what sells the story. Australian Prudential Regulatory Authority figures show that a startling 1 in 5 home loans was at least 6 times greater than the borrower's income in June quarter. So let's check out this chart. So remember how I said the debt to income ratio? What this is saying is that now in June, here's June 2021, this orange bar, more than 20%, so you can see it comes from all the way to 80 down to like 75. So that's more than 20% of buyers. This is not just investors. This is including owner-occupiers, in fact, predominantly owner-occupiers. Their debt-to-income ratios is more than 6%. This is what Apra has an issue with, right? It's not anything else. It's not that the fact that, house prices are rising. It's this figure of debt-to-income more than 6x or 6 multiple is blowing out. And really, what's causing that? It's not Brisbane, it's not Adelaide, it's not Perth, it's not regional Victoria, it's not regional Queensland where property prices are still under 300k, or regional New South Wales where property prices are under 500k. The reason debt to income is blowing out is all these home buyers, upgraders, first home buyers in Sydney and Melbourne, Sydney in particular. So, if you're buying on the southwest fringes of Sydney, the northwest fringes of Sydney, anywhere else in Sydney, so this is not the right time to be investing in Sydney. I'm not saying prices will come down. All I'm saying is price growth will plateau. There might be a correction in a year or two. Let's see how it goes. Same can be said of Melbourne. Like if you're buying these $1.5, $2 million properties in Melbourne and your household income is 100, 200k, that's what APRA is really concerned about right here. So you can see that it's not been a huge increase. So see through the kind of media, sensationalism. Even this is June data, but even 6 months ago, it was still 20%. So it's only edged up a little bit. You have to see the forest from the trees. It's not like, this debt to income ratio is, skyrocketing to the moon and back. The chart shows that. But let's carry on. A debt to income ratio would be a backdoor way to stop investors from buying multiple properties using rising asset values to reduce their loan to value ratios and borrowing more. So John Kehoe is a nice guy, but guys, like the debt to income ratio, the reason it's blowing out is not necessarily investors, it's owner occupiers. This boom has been led by owner occupiers. The previous video proves that. But yes, investors do buy multiple properties, and that could be contributing to it as well. What they mean by backdoor way to stop investors is that, previously APRA has said, guys, banks, my dear sirs, we just don't want you to lend more than 30% to investors, full stop. Or we don't want you to increase your lending to investors by more than 10% per annum. That's more of a blunt instrument. It's like very forceful. This is a more subtle way that APRA is intervening. They're saying, oh, we won't kind of do all those dramatic measures. We're just going to say, don't lend more than 6 to 1, debt to income ratio of more than 6 to 1. So it's just targeting those people who are truly overstretched. Not everyone, just those who are truly overstretched. But some owner-occupiers, especially in the most expensive markets of Sydney and Melbourne, would be caught in a debt-to-income ratio limit net. This is exactly my point here. It's mostly these expensive 1.1 to 2 million to $3 million property purchases, and the people who are buying them, who aren't necessarily ultra-rich, they're the ones that are being targeted, not your average Joe who's just buying a 500k property to live in or investing in a 400k property. That's not who's being targeted. Okay, see the forest from the trees. Concessions could be granted to first home buyers for lower value properties, great, but APRA prefers to keep the rules simple and avoid potential loopholes. Younger buyers could be further disadvantaged if any debt-to-income ratio limits account for the likelihood that their incomes will rise as the careers advance, analysts say. Okay, so basically it's saying young buyers, their careers, the wage increase is probably not going to be there. Property prices will continue to increase, so now even the banks will not allow them to get that loan. So it's just like it's a social problem. It's just making it harder and harder for first home buyers, because it's not like their 100k salary is going to 200k or 150 anytime soon, right? Wage growth isn't really occurring in the professional services sector, except for perhaps the IT service sector where there's a shortage. Accountants or bankers, all these people aren't really experiencing huge wage growth. And the banks want to make sure any change in the rules applies to non-bank lenders like Pepper, Resimac as well. Here's the thing I wanted to, so thank you for sticking around to the end. Here's the thing I wanted to say. Debt to income ratios aren't even used by a lot of banks, especially not tier 2 or tier 3 banks. Pepper, Resimac, First Mac, all these types of this, so many others, they don't even use debt to income ratios. So if you're kind of thinking, how am I going to get that next property? Guys, just don't go to Big Four. There's no additional risk really from going to a third tier lender. It's not like you're parking your savings with them. They're parking their savings with you. That's a loan. So they don't use debt to income ratios anyway. So this is not really relevant to you if you are going with a really sophisticated mortgage broker, building out a tier 1, tier 2, tier 3 lending strategy to grow your portfolio like my clients do. Lending strategy, finance strategy is as important as where you actually buy your property. Real estate experts say that any move to curb lending will cause a surge in demand that will drive prices even higher until the new rules come into force. It will quote unquote, it will trigger a rush to buy and beat the deadline, says Sydney buyer's agent Victor Kumar. Mr. Kumar is perhaps just spruiking here. If these rules come in a couple of months, it's not like anyone's rushing out to buy in the next couple of months just to get on the right side of the fence of these rules. It takes time to buy a property, especially if you haven't even started, and even in 2 months it's probably not going to happen. These things take time. Even still, there's that backdoor entry that I mentioned. So oftentimes in these types of media articles, buyers agents like to do some PR and create that FOMO. See through it, guys. It's always a good time to buy, but certainly don't just go off and rush and buy because some guy said it who's trying to promote his business or something. It's a problem being repeated around the world as central banks keep borrowing costs low to stimulate their economies during COVID-19 downturn. In fact, New Zealand just passed laws to stop negative gearing on property investments. So regardless of which side of the debate you're on, Australia, we're not going to see negative gearing go anyway anytime soon. I can hang my reputation on that because Labor lost the last election because of that, right? So it might happen in I don't know, 10 years or something like that. Definitely not going to happen next year in the election. So don't worry about that. But I think it's good, actually, that APRA's coming in to do this. You know, it's going to actually soften these really unsustainable increases, especially in the Sydney, Melbourne markets. If you're in Sydney, Melbourne, you want to invest in property, guys, don't do it in Sydney, Melbourne. The place to be doing it is outside Sydney, Melbourne. And if you're in Sydney, Melbourne, you don't have a property and you're like, well, this is going to make it, these debt to income ratio limits are going to make it so much more difficult for me to buy a property. Don't buy a property, rent vest. I've done other videos on why rent vesting is so important. Continue to rent. Rent money is not dead money in all instances. Use your savings, use your borrowing capacity to build a portfolio, and in the future you can build passive income and just maybe liquidate one or two assets to buy your dream home in 5-10 years time. So that's an avenue, and an avenue that should be increasingly pursued by young professionals or by young families or mature families who haven't yet got a property in Sydney, Melbourne, because I don't know when it's going to be, but at some point Sydney, Melbourne is going to get a correction. Okay, guys, so hopefully that was super useful. If it was, tell me. Leave a yes below in the comments if it was. Give it a thumbs up. Give it a like. My name's PK. Always remember that the most important real estate is the 6 inches between your two ears. Catch you later. Bye.